for the part one of this series, we're going to go over how to win a deal, basically how we identify a market and what we look for, how we underwrite, and then ultimately how we get offers out the door to try and win these deals. So with that being said, I'm going to kick it over to Dustin to kind of introduce himself to everyone and kind of kick it off.
Yeah. Great to see everybody. Lots of familiar faces for sure. And we'll kind of be diving into this. And so this is our background. Oops, sorry. No, it needs to be full screen. So this is background, have put together 11 deals, 12 deals, 125 million plus, 1,600 plus units. I've gone full cycle on 6 and about to go full cycle on number 7. We're about to be under contract on that deal. We had we did an event at the deal more recently. And then in terms of performance and all that, it's been about a 2x multiple over around a 3-year hold. Obviously, there's been a good bit of cap rate compression from that as well. So, but we've also done, performed, executed the business plan, increased the NOI by quite a bit. So.
Awesome. Yeah. Well, step one is know your market. So for us, we always we get sent deals from all over the place. Step one for us is to narrow down that focus and understand where do we actually want to spend our time? Because if you're looking at deals all over the country, it's going to be very difficult to understand, where there's potential value, where the path of progress is. And to really understand the risks involved with any given marketplace. So for us, understanding where we want to be is by far the most important. If we get sent deals that are in rough areas, we're not even really interested in looking at them because it's not an area that we believe in. So we want to be excited about a deal. And step one for that is to be excited about that location.
Awesome. Yeah, 100%. Because of all the things that you can change, you can't change the location. So can't change the zip code, can't change the schools, can't change your neighbors. So location is number one for sure. So the areas that we concentrate are the Texas Triangle, DFW, Houston, Austin, San Antonio. Right now, we're have the most traction in Houston, and we purchased a deal earlier down there, or earlier this year down there, and so really big on Houston. It's obviously it's a huge metro and all that, but very diverse, and it's just if you, in terms of growth and things like that, has a lot of things going for it, and so we've have a lot of resources down there and all that, but it's a city that we're really big on. Oops.
Yeah, so there's a couple of questions that we kind of pose to understand the market. Do you have a property management company that knows the area? The number one question we ask when interviewing property management companies is, if we get an asset that is in a market that you currently don't have any properties, would you manage it for us? And we ask that question because we want to know if they're willing to go into market that they don't currently have a presence. And if they say yes to that, that's when our red flag goes up, because we know that's going to be really challenging from the management perspective. If you've got a regional that's got, say, 8 properties in DFW, but then they have 1 property in Oklahoma, and that regional is getting spread between Oklahoma and Dallas, it's going to be really challenging to manage because most of their time is going to be spent on Dallas. So that's the first question we ask to management companies is, if we get an asset in an area that you're not in, would you take care of that for us? And we ask that because a lot of them at the opportunity to get business will say yes. and they'll just take it on. And sometimes that's not always the right approach. And so for us, we'd rather have a management company say, you know what, unless you have 500-600 doors there, we really won't move into a new market. And so when we get that response, we're a lot more interested in exploring them as a management company, just because it's an indication that they've got all their ducks in a row. They know what they're good at, they know what they're not so good at. And that's really important to know before you agree to work with a management company. And then next step is, how well do you know the area yourself? Have you been there? Have you seen the growth over time? Have you seen areas improve or get worse? It's hard to know if you're just showing up for a property tour with a broker, you're spending 30 minutes on site. It's really hard to get an idea if you don't have more experience in that market. And then from there, what is your plan for asset management? Is it all the way across the country? How often are you going to go and view it and actually be boots on the ground? Because every week things are changing. When you're talking with your management company, every week stuff's happening. And it can be very difficult to stay on top of if that property is across the country or if your portfolio is extremely spread out. So these are some important questions to kind of think about when you're looking at a property or a market to invest in. And then, some of our Houston resources and why we've really settled on Houston. I'm from Houston. I grew up in the Woodlands area, which is on the north side. So I've been there for almost 20 years. So I've seen the growth happen. I know the good areas from the bad. And then I've still got family down there. I got family in the Woodlands and then Richmond, which is southwest Houston. And so those can be great resources to tap on and say, hey, I'm looking at a deal in this area. What are your thoughts? Is that area improving? Is it not so good? Just having more people that you can trust, is a really good resource. And then our management company is based there. So we work with Asset Living. Like I said, it's really important to have a management company that knows a market. And Asset's been there since 1986, and they've probably managed just about everything down there. A lot of times we'll be talking to them about a property, and they've actually managed it in the past, so they know it extremely well. And that's invaluable information when you're looking at potentially putting in multi-million-dollar offers on these deals, to be able to have insider information about what skeletons are in the closet here can be really, really beneficial. And then it's also easy for us to manage. Like I said, I got family here, so it makes it really easy for me personally, because I get to check on properties and see family, and it's kind of a win-win for everyone. And it's a 3-hour drive from Dallas, so it's not like a stretch for us. It's an easy trip, so it just makes a lot of sense. And these are kind of all of the things that really why it makes sense for us to be in Houston. And on top of that, just looking historically at some of the population growth statistics, from 2010 to 2019, Dallas led the country in population growth, and right behind it was Houston. So like Dustin mentioned on a previous slide, we're big believers in the Texas Triangle. And we like to focus our attention, again, on markets that we know and we have a lot of resources in.
Awesome. So one thing that we really kind of a spot check whenever we're looking at a property is actually, I think we got 1 or 2 properties today, and we're looking at home values. So home values it's not a, the home value is this, if it doesn't fit your criteria, then yes. But, for us, it's something that we look at. It's a nice spot check. It gives you a sense of the area. It gives you a sense of, hey, is it easy for people just to go buy a house as opposed to rent your apartment complex. And in our case, most of what we're looking at A- deals. So we're looking most of, I think 89% of the offers that we are making are kind of that first gen value add. So kind of that early 2000s, they haven't really been upgraded, but they're and they're still in really good shape. A lot of times the clubhouses because they're, the clubhouses are between 10 and 20 years old. A lot of times that they need to be upgraded. And a lot of times the units, most of the deals we're looking at, the kitchens, laminate countertops, sometimes they've started to go to quartz or granite, but for the most part, it's, laminate. But this is just this is a good spot check just to kind of get a sense of the area and really, what you're getting into. And we've spent, we spend a ton of time. I'm really hammering in on the area just because you can't change that. And we spend a lot of time and resources just trying to figure out, is this particular area, and a lot of times we've offered on so many deals in Houston. There was one deal earlier a few weeks ago, we were in the best and final, and we'd offered on the property next door and toured the property next door. And there was another deal, similar situation where, we'd offered on the deal next door. So we knew the areas, but sometimes there's, we're, although, we're very familiar with Houston, all that, there's pockets, that are even, a little bit newer to us. And so we, try to want to educate ourselves. And so this is something that we dive into.
That's another really good point, though, Dustin, that I'd like to point out to everyone, though, is the more time you spend in a market, the more familiar you are. And then, maybe you lose out on a deal, but then the deal next door comes up on the market. So you know exactly what your comp just traded for, and the fact that they're going to have to push those rents as well. And so, again, if you're spread out, it's harder to see those sort of opportunities. The deal that Dustin was actually referencing to, two of the neighbors traded. So around similar price points that we were looking at the property. And that made us feel really good because we knew that whole submarket essentially had to raise rents and execute a business plan. If somebody's in at a really, really low basis, and then you're coming in at a much higher basis next door, that's going to make it more challenging for you because those that are at a lower basis don't necessarily have to execute their business plan to perfection like you would have to. But then opposed to if a whole submarket is trading around the same time, everybody's going to raise those rents at about the same time. So that could really help, bring a lot of confidence to your business plan. And then from there, we're looking at crime. So we want to be in good areas that have strong home values, and we also want to be in areas that have low crime. And for us, that means pretty much staying outside the loop. As you can see here, this is a great resource, communitycrimemap.org. I'd really highly recommend checking that out. They're up-to-date incidences that happen from the police reports and everything. So this event is murders. Obviously you don't want to be in an area where that's taking place very frequently. And as you can see, the frequency of these events gets less and less the further out you go. And the reason is, Houston has been known for some strange zoning, and a lot of that takes place inside the inner loop. And with that, really with any city and, inner cities, you just have more crime. And the Woodlands at the north of this map that's where I grew up. And it was one of the first master plan communities in the country. And so as it began to grow, a lot of these other surrounding cities, Katy, Cinco Ranch, Sugar Land, Pearland, they began to take notice and they began to do similar things. And so everything in the suburbs of Houston began developing in similar fashions to the Woodlands, which is a master plan community. And as a result, you had strong home values and a lot of low crime and a lot of really intelligently zoned communities. And so that's generally where we focus, because we know everything outside that loop is very new. It's very well thought out. And, you can see pretty clearly from this map that there's definitely not as much crime. And then there's, pockets that we know that are just notorious. So at the intersection of 45 and Beltway 8, right there on the north side, that is called Greens Point. Its nickname is Guns Point because it has, always been an area of a lot of a lot of crime. Our manager actually at the Henry used to manage a property over there, and she had to have armed security with her almost everywhere she went. Constant threats for drive-by shootings. I mean, just not great areas. That's not really where we're interested in investing. And so as a result, we like to kind of stay to the suburbs and surrounding areas of Houston. It's just where we know a lot better. And it's just gonna, you're gonna have a lot less to deal with than inner loop. So, Dustin, I don't know if you had anything else to add to this slide, but
No, well, the only thing, if you wanted to kind of just mention some of the areas outside that were that we've that are of interest to us.
yeah, we've offered on deals in Atascocita, up there in the Northeast. We really love, so where the Henry at is the Beltway and 90. That's a great pocket. There's a lot less supply than the West Side. So it's everything over there is pretty much brand new and really up and coming. As you can see, 90 cuts right downtown. We really love that. And the Beltway can get you north and south. So again, we like to think, how would a resident think? If I work downtown, and I live on the north side, it's going to take me 45 minutes to get down there. But if I live on this northeast side, I can cut down 90, it's 20 minutes. These are important things that are going to go through residents' minds as well. We've offered on some deals in the Jersey Village area outside the loop there. Sugarland, Richmond, we've offered, love that area down there on the southwest side. A little bit in Deer Park and in the kind of Katy area. So everything's pretty much on the outskirts. Everything inside the loop. Again, it's not that you shouldn't invest necessarily. It's just for us, our preference is outside the loop. It's what we know a little bit better. I think there's great deals to be had on the inside the inner loop as well. For us, it would just require a little additional homework for sure.
Awesome. Okay, so we're going to talk about, this was a deal that was listed earlier in the year, and we had the opportunity. We were in the best and final, and we toured it and all that, and we did put a tremendous amount of energy into it, and I think we had a really good shot at winning the deal, honestly. But the numbers penciled out really well for this particular deal, and and we had quite a bit of room to run in terms of pricing. So I think we had a really good shot at it. We ended up ultimately passing on this deal, and kind of going back to the location. And the reason why we passed on the location is if you kind of look in the upper right hand corner, that West Oaks Mall, it's the mall's dying, and we just weren't comfortable with that, and we didn't know they'd everybody, oh yeah, there's going to be some development or something, and that's a pretty some of that stuff can take 10, 20 years plus to see fruition. And anyways, we just couldn't get comfortable it being next to this mall that was not being utilized. It was pretty vacant, as you can tell from this picture. And but it was a nice looking deal. Value add story was there. I can't remember the exact vintage, but it was kind of that early 2000s, and just a real nice deal. Like I said, penciled out really well. Cash flow was good. Equity multiple looked good, but we couldn't get comfortable with the area because of that mall. So ultimately, so what we did in the best and final, we knew if we put in the offer that we put in for the initial offer, we knew we wouldn't win. So that's what we did.
So, I have a quick question, if I can, uh, if I
Sure.
can make that question.
Yeah.
So, yeah, so the property was penciled in really well, right? But
Yep.
then you guys took a look at the area and see the path of progress, and you guys didn't see the what do you, you know, the par- you guys didn't see that it's going to be progressing, or it doesn't have like a future value or something, then you'll pass on those kind of properties most of the time, or
We just ultimately we weren't comfortable with the mall and
it was just the
where it
mall.
was, yeah, where it was headed and all that.
Mhm.
You know, we've looked at quite a few other deals in this particular submarket, and some of them we've liked because there was some distance
Mhm.
from this mall, but we just, you know, as soon as you pull outside of this complex,
It
you
was
know,
just quiet.
yeah, I mean, it's like you see this dying mall, and so just
Yeah,
in our, you know, we're trying to, you know, trying to be in the mind of the tenant, and it's like, you know, if you can live here, or if you can live right down the road and not look at this dying mall, you know, I would, you know, and it's all things being equal, I'd rather just live over there. So
was it at like a high occupancy in that already?
yeah. Mhm.
It was.
Yeah,
Oh,
it was, I don't remember the occupancy exactly, but I mean, it was, yeah, it was in the 90s for sure. So
oh, okay.
yeah, yeah.
That's good
But
to know too.
yeah, so I mean, we you know, we could have, we had a really good shot at winning the deal, and we kind of saw, you know, where we could go in pricing and all that. We had plenty of room, and we just, you know, ultimately passed because of is that location. So we can't, like, you know, going back to what we've talked about in prior slides, you know, you can't change the location, and so we just weren't comfortable with that. And I mean, you know, frankly, we're, you know, the way we kind of, you know, we tried to think as long term as possible. I mean, we could be potentially be in this asset. I mean, could be 3 years, could be 5, but you know, it could be up to 10 or so. And so, you know, if we're going into a deal, and we're going to, you know, go after a deal, and all that, we want to be, you know, we want to be extremely confident in the deal that we're going after. So
And just
So
to
you kind of have to be confident in the market, in the surrounding areas to take it on, to be comfortable enough to take it on, take on the deal.
yeah, absolutely,
Right. Yeah.
100%. Yeah.
Yeah, and just to kind of echo that, so my dad actually lives about 20 minutes south of this property, and it's something I went to him and asked because I wanted to get his thoughts on that area. And obviously the mall was a concern for us, and I wanted to run that by somebody more familiar with the area. And he had said that, you know, the last 10 years, this area has kind of been on the decline. And you know, like Dustin mentioned, we want to be real excited about the location. We want to be in the path of progress. We want to be excited about the deal, where it's located, and it just didn't get us that excited, and it was too much of a risk to take on, because you know, if a majority of your tenants work at this mall, and then all of a sudden, you know, the mall goes dark, that's a big concern. And so, you know, it's just, you know, in our minds, it was a lot more risk being in a location that was on the decline rather than the incline.
Awesome. Thank you.
Dustin, what was the median income in this area?
I don't, it's been a while. Hayden, I don't know if you remember or not, but
Yeah, I can't remember off the top of my head.
Okay.
yeah, I think we offered on this, I don't remember, April-ish, maybe. I don't
Yeah,
know.
it's been a little while. And I think we'd like to probably ask we're going to get to questions at the end too. We got a few more slides.
Okay, sure.
But yeah, I appreciate everybody. If you've got questions, drop them in the chat too, and we can address them right at the end. Just, you know, for to respect everybody's time. But Step two, from there, we go to, once it's checked the area box, we're excited about the area, we'll go and underwrite the deal. And that's where we dig into the numbers, and really try and understand the story and if there's value to be had here. So yeah, Dustin, would you mind going to the next one? Here's an example. So this is something kind of what we look for. This is some screenshots from our actual model that we use. So when you're putting in the actuals and unit mix, that's really where it gives you the opportunity to see how the property is being run. If there's the potential for management upside. So two things that we look for immediately is the total economic vacancy and other income as a percentage of GPR, or gross potential revenue. After looking over hundreds of P&Ls, you start to see some averages for properties that are well maintained and properties that are not well maintained. And what we've noticed is that your total income is typically 100% of your GPR. And what that means is typically you get about 10% loss from economic vacancies and 10% gain from other income. So you have your GPR, then you have 10% loss, and then 10% gain from other income, which basically negatives out. And so your GPR and your total net income on a stabilized deal that's being well run should be about the same. And this is actually the underwriting for the Henry, and why we got excited, because we saw there was a little bit of a disparity there. We saw economic vacancy was at 20%. So that's the first indication to us that there's potential management upside. They're losing out on potentially 10% of additional income. And we liked that their other income was in line with that kind of rule of thumb. It was right around that 11% mark, so that we knew if you put in potentially a better management company, there was room to burn off some of that loss to lease or concessions, whatever it was. In this case, it was loss to lease, bad debt, and multi units. So as you can see there, you got 6.9. So that's a little bit high. And then on top of that, their vacancy is, compared to some of the comps in the submarket, was a little low as well, hovering right around that 90% mark. And they had over 3% in concessions. So that's pretty high. So those three line items, the vacancy, concessions, loss to lease, bad debt, and model unit, those three lines in this spreadsheet equal your total economic vacancy. And that total was 20%. So that was the first indication for us, hey, there's potential value here, because you want that really to be around 10% and your other income to be around 10%. So that would be one thing that I'd highly recommend if you're actually trying to underwrite deals yourself, to start paying more and more attention to that, just because we've looked at hundreds and hundreds of P&Ls, and that's something that we've started to take notice of. And it's a really easy, high level, if you're running through a model real quick and you're getting sent deals every single day, trying to figure out which one should I actually spend time on. You can narrow down your focus by saying, okay, which areas do I like? And then when you do a quick underwrite, you can see from looking at key statistics like this, which ones have the most potential value. Now, this is just inputting the actuals and unit mix. This isn't digging into any of the comps or anything like that. So this is just a part of the picture. But this is what we use to be able to understand, is this worth digging into more or not? Because we spend hundreds of hours on every single deal before getting that offer out the door. And we want to make sure our time is well spent. And there's too many deals that come out on the market for us to do a full in-depth dive on everything. So you've kind of got to have some criteria that you look for, whether it be the area or, economic vacancies on P&Ls, to really give you an idea, is this worth digging into or not? And for us, we immediately saw potentially 10% of income right off the top that we could potentially increase at this property. And that's a lot of value. When we'll go to the next slide, and Dustin will talk about the total income, which that makes up about half of our push over a 5-year hold. So
yeah, so here's the underwriting for the Henry that we purchased. earlier this year. And, as you can see, we have it's a pretty, just in general, it's pretty light push. It's 21% over, or the GPR is only 7% over 5 years, and income growth is only 21% over 5 years. Part of that, you won't, this was, so I think part of the reason why, we were able to land this deal, is because of COVID. I think there are a lot of people on the sidelines. This was also when we were bidding on this deal, there were a lot of deals out. Remember, for the folks that were bidding on deals, there were basically no deals as soon as COVID hit and really started shutting everything down. So there were really no deals from April until about July or so. And then they started to come out. And I don't remember when I think this came out maybe in September. But anyways, so there were no deals, and then it was a flood of deals. And so a lot of people, including ourselves, there were so many deals out. So you really had to, I think that's, you really had to sift through a lot. And I think a lot of people were spread thin. And so the offer counts were lower and all that. I think the fact that people saw, 2012 deal, they assumed there was no upside on it. But, as soon as you went into the complex and, when we did the tour and all that, it was fine. But then when you went to go shop some of the comps and you saw the rents that they were getting for a very comparable product, it was very obvious that there was, a lot of upside on this deal. So, those are, so in terms of just risk mitigation and all that, because at the end of the day, this is, it's a risk play. And, for this deal, we didn't really have to push income a whole lot. And, we're able to, have strong returns, even with kind of a lighter push and all that. Did want to mention also, and that another kind of piece of the puzzle to why we felt really good about this deal was we had over $5,000 a door in CapEx, so it was close to 1.2 million. So we had a lot of cash, and we had recently finished the office and clubhouse. We're still waiting on some furniture to come in because that's go COVID. But so we've kind of fixed or remodeled that piece, the interiors for the units. We haven't really started to push on those. We've done the paint color. That was one thing. As soon as we walked into their units and saw their paint color, it was noticeable. I'm not one that can put colors together and all that, but if I see it up, I can tell, okay, this does not look good. And it, it was very dim and dark when you walked into the units. It was not inviting, and the office was pretty similar. It was very dim and dark and just not very inviting. And so we turned it's light and bright, and so very inviting, and makes you excited to be there. Anything else you want to add to this, Aiden?
No, I think you pretty much covered it.
Okay.
Now it's time to tour. After you've narrowed down your criteria, which area you want to focus on. You've underwrote the deal. Now it's time, if it checks all those boxes and it still looks good, time to set up a tour. So from here is when you reach out to the brokers again and you set up a tour with them, and you actually go in and walk through the property with them. And it only takes about 30 minutes, but it's an opportunity to kind of build rapport with the brokers, which can be invaluable down the road as well. So You know, sometimes it's good to tour some deals that, you know, are a little tight too. You're not really sure how competitive you're going to be, but if you get the opportunity to build rapport and potentially bid on some deals with them, it's a really valuable opportunity. So after you've identified the location, you've underwrote the deal, then you go out and tour, and it could be tempting to somebody new, and it definitely was when I got started, to want to tour every deal that comes out. And the problem with that is you spend a lot of time driving around and then you underwrite the deal and realize that the numbers aren't even close. And so then you realize how much time you've actually wasted, and, you know, it can start to get frustrating. So that's why, you know, over time you kind of learn, you know, do your initial homework first before you waste your time or potentially a broker's time as well. And so from there, yeah, if it checks those two boxes, step 3, time to get outside the office and time to tour.
Cool. Yeah. So, you know, hit on it two slides ago or so. But, you know, time to shop the property. You know, as we, you know, talked about a few slides ago, extremely important to, you know, not only to secret shop the property that, you know, as a tenant that you're looking for, you just need to kind of be careful there. You know, if you've already toured it, then they, you know, might know you. But as far as shopping the comps and all that, I think that's, you know, you just can't supplement, or you can't exchange, you know, getting out there and taking a look at the comps. And, you know, it is like at the Henry, for instance, you know, the property next door, it's I think it's 5 years newer, but and, you know, similar product, different type of product, but similar product. The Henry's garden style, that's a Texas wrap next door. And, you know, but the interiors are somewhat similar. They had a few little upgrades, but it wasn't anything that we couldn't do very easily. And they were charging, you know, anywhere from 100 to, I think, 250 plus more than the Henry was. And so that was an easy one. Then when you went around the corner, similar story. And you know, and then, you know, one thing that we really like to do is, you know, really drive the area quite a bit. You know, so, you know, you drive for this property, for the Henry, we drove, you know, obviously into the neighborhood behind. We went over into all the kind of neighboring neighborhoods. There's actually retail that's being developed, and it's being actually developed now. They're moving dirt and all that in front of the property, so we're excited about that. At the time, you know, they're also I don't remember if it's finished or not, but there's a complex that's about a mile down from us that right now our effective rents are about $1.21. They are going to be asking $1.74 for their rents. And so, you know, we feel really good about that. That's, if, you know, that's only raising our ceiling. So, you know, so we're, you know, it's just another kind of check the box, because we were buying a newer property. One thing that we were very cognizant of was the, you know, what did it cost to build? And so we talked to a few different builders and all that, and so we got anywhere, depends on lumber and all that, and but you know, in that 160 170 range or so. And we bought this 128 a door, so we felt really good about that, because anybody that was going to be building would have to charge more than us just because of the difference in basis.
And then when you're actually on site on the property, this, you know, not only gives you the opportunity to confirm what's in the OM or the offering memorandum, what the broker gives you, But then it gives you the opportunity to really see the potential value add in a property. So the first things that we kind of noticed with the Henry was, like we mentioned at the start, it was on Highway 90, and it had this existing billboard from Sync, the previous owner. And we loved that fact because, when we put our brand up there, we were going to simplify and clean up the banner from what they had up there. And, we basically get a free billboard on a very, very well-trafficked highway. And so that's, helps drive tenants in. One of our greatest drivers for traffic is drive-by traffic. And, this billboard and being right on 90 was one of the things that we really loved when we were actually out at the property and touring it. And then from there, looking at potential ways to add additional value. So this picture at the top right, that was the previous maintenance shed. And, the way things are going, everybody orders their packages offline and, through Amazon and stuff like that. And so package lockers have been a major demand from tenants more recently. And when this property was built in 2012, that was not the case. And so we saw this as an immediate opportunity to actually wall off a section of that shop and then put in package lockers there. So our residents, and adjacent to this, just to the left of those doors, is the mail room as well. So now you can get your packages and your mail at the same time. You don't have to worry about getting wet when you're picking up your package or anything like that. You can drive right up to it. That was an immediate value add that we saw that was really simple to do. And all we had to do was put a wall to divert it. And then we created a path and an entrance in that side there so that the maintenance team was actually able to preserve some of that shop as well. So it was really a win-win, able to add an additional amenity and preserve space for our maintenance crew. And that was one of the immediate things that we saw. And this is right in the gates as you're driving through. So we're constantly looking for how can we add additional amenities, make life a little bit easier for tenants, because that helps with retention. If life is hard for a tenant, if they're tired of getting soaking wet from running to the leasing office from their unit or something like that to get a package, this is going to make their life a lot easier, and resident retention is going to get easier and easier over time. And then the picture in the bottom right, we saw this big open green space. And to us, that was a huge amount of opportunity because as it sits, we've got a clubhouse that has a game room, it's got a kitchen, it's got a gym, and then the pool. And then outside of that, those were the main amenities. And so we saw this, and it also had a dog park at the very, very back of the complex. And to us, that didn't make a whole lot of sense because the reality is, and I'm a dog owner myself, I'm not going to walk my dog all the way to the other side of the complex every single time. I got to let him out. And so neither are residents, and so we saw this as an opportunity to add additional amenities like a dog park that's central to the entire community, and an outdoor grilling station and fire pit. So those are projects that we're actually currently working on. And that was one of the first things when touring the property and getting on site. You just get to see the scale of the space that we had and get a feel for what would actually work here. So that's the questions that we're constantly asking in our minds as we're walking the properties. Because again, the broker is going to sell you on a value add story in the OM. And part of that may be true, but you've got to confirm it and go out there and actually see for yourself, is this enough space? Is this going to be well received? That's another question that you can actually ask the manager or the maintenance guys. Would tenants even like this? If you had $1 million to put into the property, where would you put it? That's one of the questions that we ask the manager or the maintenance staff when we're touring a property, because they're the ones that have been on site. They know the problems and they know what needs to be fixed in order to run the property a little bit smoother. And so from here, we're going to actually bring up Ruben Ortiz.
One thing I just wanted to mention. So this maintenance shop that we've converted, we've probably toured probably more than that. It's probably, but the deals that we were very serious about and that we offered on and that we were potentially in best and final, probably about 5 deals where we were going to do this exact same thing. I think Arium, the one that we mentioned that we passed on, I think this was, I think that was one of them too. But you know, there's a lot of efficiencies when you are focusing on a market. And, you know, we've offered on so many deals, you know, in the different pockets that we like, that there's just a lot of efficiencies with, you know, we know what to look for. We've offered on, there's one particular builder that we've offered on 3 of their products, and we like their product. We know what to expect. You know, some of these products, some of the builders, we know, we know what to expect. We know, you know, oh, we can do water conservation here. We've already seen 4 of his buildings. Or, you know, in this instance, you know, we can, you know, we can add Amazon lockers, and there's some other things I can't think of right now, but there's just a lot of efficiencies with, you know, looking at, you know, similar deals in that same submarket. So anyways, yeah, well, further ado, Ruben, do you want to, yeah, you're all unmuted if you want to kind of go over due diligence.
Sure. Dustin, Hayden, first of all, thanks for putting this together and allowing me some time on here. I appreciate it. So yeah, you know, once you're set to tour a property, or you've gotten your LOI accepted, et cetera, you know, we're the guys, we're general contractor, we're the guys that, you know, it helps to call. Normally our process, the same team's process is we get a call from, you know, someone like Hayden or Dustin to come out and tour a property with them. You know, it's a great opportunity if you've got a good relationship with a multifamily general contractor to bring them on site and help walk the asset and help you, you know, identify any deficiencies in the buildings, help you identify, you know, potential property upgrades, you know, whether it be certain things like, you know, is something doable or not on property according to the space, to city requirements, etc. Also, you know, helping identify interior upgrades and what better suits the property and what will actually work for the property. As you can see on the picture here on the left, one of the main things that we like to do when we get that call is bring on site not only myself but a couple others on our team to help tackle some of these large walks. You know, for example, the picture here on the right, I think that day we walked, it was a 300 unit property where we have to walk every building and put together a comprehensive scope of work for our clients. We understand the importance of, you know, helping put together these scopes of work that will allow you to hone in on your underwriting and make sure that you are well capitalized going into the asset. And you know, I think one of the things, or a few of the things that we look at specifically, are some of the larger components. Are the roofs in good shape? You know, what does the foundation look like? In most cases, when we're doing due diligence on these properties, we bring our plumbers to scope all our plumbing lines and make sure that everything is in good shape. Depending on the year of the asset, you can run into multiple issues down the line if you're not taking care of certain items in the due diligence. And you know, working with a GC that is knowledgeable in the space that, will give you uh, the right information, whether that, a lot of times, sometimes clients are under the impression that certain things can be done when, realistically it can't happen. And knowing that ahead of time, when working with a GC, can save you some headaches down the line for sure.
Yeah, because we're, like you'd mentioned, Ruben, this is a 300 unit complex. If you come in undercapitalized, there could be big repercussions for that. You've got a lot of investors' capital on the line, and these aren't properties that you can just fund yourself a lot of times, because you're talking multi-million-dollar renovations. So for us, it is extremely important to run the scope of work by somebody like Ruben, to ensure that our numbers are accurate and what we're planning for the property is feasible, and our budget can support it. There's a lot of times that I've come to Ruben myself, and under the impression that certain things cost, especially if you're looking at a broker's OM, they will give you estimated renovation costs a lot of time. And then I'll go to Ruben and get the actual cost in today's market. Ruben, what kind of challenges are you facing right now? I know, lumber was all over the place, but labor is one of a big challenge for us. Timelines for getting material has been a challenge as well. These are all things to really think about. And somebody like Ruben, that's an expert in dealing with that all the time, is a great resource to run that game plan by.
Right. Absolutely. Yes, running into challenges like, material delays, material prices changing literally almost daily right now, is something that we have to stay current on. And also, let our clients know of these changes. One of the most shocking, I think, the changes that we saw was, for example, carports is a big, it's fresh on my mind. A few months back, we could get carports done for as little as, $1,100, $1,200 per space. And in, as after COVID, and all these material changes, prices went up as much as, 21, 22, as high as $2,800 per space. And, that's where we're working with a good GC, can save you a lot on later on down the line. Not knowing that these changes happened, not knowing where prices are at, whether it's material, labor, can really, again, hurt you down the line.
Awesome. Well, yeah, I appreciate you jumping in and going over the importance of the due diligence. It's a vital, part of this process, because when you're going into putting in an offer on a property, you've got to have a CapEx and a rehab budget. So it's great to kind of run it by Ruben, that can at least give a high level look. So Ruben, if anybody wants to reach out to you, what's the best way to do that?
Yeah, absolutely. We, love to hop on a call if you've got any questions. Best way to reach us at is info at sayenconstruction.com. That's the best way to reach us at. Send us emails, also social media, _justsayen. Otherwise, I believe the guys are going to share all my information after the webinar. But yeah, again, please feel free to reach out with any questions, emails. I'm happy to answer any of them.
Awesome. Well, yeah, thanks again, Ruben. I'm going to remove you from the spotlight, but it looks like you're already getting some questions down there in the chat. So I may want to leave your contact information down there. So
I appreciate it very much. Thank you.
Absolutely. Thanks again, Ruben.
Yeah, so that kind of, we'll kind of dive into the questions and all that, but that kind of wraps up, the first part. We have the second part coming up, as we mentioned at the beginning of this, on October 11th. Gary Lipsky will be giving us a breakdown of asset management. I mean, that's one thing buying a deal, and then it's a whole nother thing to operate and execute. So, and then Rob Beardsley on November 8th will be giving a full cycle case study. He has, I think he said one or two deals that are going through the process of selling. So we'll have to kind of, anyways, but he'll kind of give more details on that. So excited to be partnering with these guys, and I appreciate everybody coming out. So.
And then this presentation will go in an email afterwards, and we got some helpful links. We got a great Facebook community with about 1,500 active investors and sponsors in there that you guys are welcome to join. And these are all linked, so it's really easy. We got our website and investor portal if you're looking at or interested in looking at future opportunities as well. So yeah, appreciate everybody joining. And like I said, the slides will go out and we're recording this as well. To really appreciate everybody joining. It looks like for those that want to stick around, we do have a few questions coming in. We can do a short Q&A and let's see what the first one is here. Nakayama asked, which vintage building do you consider running scopes for the plumbing? During your due diligence phase, I would recommend, doesn't matter how old the property is, you want to make sure the plumbing was done right. So scope them anyways. So whether it's a 1960s property or a brand new property, you want to make sure that those lines are done properly and working properly. So have your GC scope them anyways, no matter the vintage.
Let's see.
Josh asks, I'll pose this one for you, Dustin. After due diligence, when or how do you decide to sell the property? How do you guys determine your investments are legitimate, and how do I get invited to be a part of the deal?
Yeah, I don't see the question, but anyways, yeah. So basically, when do we decide to sell?
Yeah, that's the first part of it.
Okay, and Andy, we see your raised hand too, so we'll get to you after this. But yeah, really, I mean, I think if you're able to deliver results and you've kind of executed your game plan, and one thing that so this is our Hayden and Dustin's opinion, but if it's a little older asset, you're going to just naturally, there's going to be more issues, the longer you hold and all that. So that's something to take into consideration. Definitely if it's, if it just kind of depends on the area and all that, and how you feel about the area. There's a deal that we're selling right now, and we're about to go under contract, and it's an older deal. It's a chiller deal. It's been an awesome deal. It's in a great part of town, great schools and all that. And we got to where just felt like it was time to sell. That one was maybe a little bit more market driven, for a C-class asset. When we originally bought it, I think cap rates were, in the 7 range or so, 6.5, 7 range for a C-class deal in DFW. And I can't remember what our cap rate is, depends on, income and all that. But, we're in the 4s. We're selling this deal in the 4s. And so, that's really attractive. How long is our C-class deals going to be, trading at that low of a cap rate? I don't know, but for us, it was, we had refinanced it, and a lot of and we've done well in the asset, and so it's gone really, really well. but it felt like it was, time to sell and kind of take advantage of the market.
Absolutely. So we like to say we're opportunistic.
Yep. So Andy, if you want to, I don't know if your questions in the chat.
Yeah.
Or
Thank you. Yeah,
Yep.
I was that was great info on that. To sell. So I kind of like was going back to the due diligence. So you would call Ruben in during the due diligence after you're under contract, correct?
Yeah. So he does the physical inspection, but I talk with him on a regular basis, almost daily. And so if there's a property that we're really serious about, and it looks like we're going to be competitive, we're going to be in best and final, I will go to Ruben and go over the scope and just make sure that everything looks okay. And so that is pre-LOI, or really pre-LOI, or pre-being under contract.
Pre-LOI, okay.
So yeah, I want to be respectful of his time, so I don't want to ping him with every single property that we're looking at. And frankly, it's hard to win a deal. So there may be a lot of deals that you just don't get under contract. So if it looks serious and there's really some items that need to be looked at, like maybe it's an older deal that has more of a value add, or for instance, it needs a paint job and it's stucco, it's not hardy. Well, stucco takes more paint than hardy. So getting an estimate on what does it take to do a 3-story garden style stucco building, X number of units, what's that going to cost? He can give you some estimates for that sort of things. He can actually look the property up, or if he's able to actually go out there and walk it for you guys. So, but that sort of information is extremely, extremely helpful. And over time, you start to get better at understanding, ballparks like, a 3-story garden style hardy is $700 to $800 a unit for an expense. And stucco, like I mentioned, takes more paint. It's closer to that 900 to 1,000. So you can use that to budget and then dial it in if you get awarded the deal with him or something like that. But yeah, we'll talk with him.
So if you have like a good relationship with him to kind of have him come out on the property tour, you said before the LOI, right? Yeah. Okay. And
it's a relationship business. And who is everything. And so we've got a good GC that we turn to when we need to. We've got good people for debt, for insurance, for taxes, for all these things that go into our underwriting before we send those offers out, that we're dialing that underwriting in before we submit that offer. So in that slide on our model. So, I've got our model kind of formulated based on the vintage to auto-populate certain expenses based on how old the asset is, because like a 1970s asset is going to have higher R&M, for example, than a brand new asset. So, we have ballpark figures that we do our high level underwriting, and then we go to people like Ruben, like Asset Living, our management company, like we go to our tax professional, our insurance professional, so we can dial in each of those line items and have an accurate budget and accurate income from professionals in their respective areas before we submit an offer.
That's awesome. Thank you so much for that.
Absolutely.
So Ed and Laura had a question. During underwriting, do you give a little bit higher value to decreasing expenses versus increasing income? Decreasing expenses seems a little less risky. It's all relative. I guess I would say, like we mentioned during the presentation, this is you're evaluating risk, and so I'll give, to be contrary to your assumption, I'll just give, an easy thing. Well, if I'm billing back water and they weren't billing back water before, that's a really safe income play. Or if we're raising we're raising, a fee from, $10 to $25, and that's everybody else is charging $25 in the submarket, then it's, completely valid. Or if they're the complex you're going after, they're covered parking. I'm just throwing out numbers. If they're charging $10, everybody else is charging 35, that's an easy one. So it really just depends. I mean, we've got our expenses pretty well dialed in. The biggest expense and the biggest one that swings everything is property taxes. So we actually work pretty closely with our property tax consultant on deals. We'll get a lot more if we're in the best and final, and it's, we're potentially going to win the deal and all that. That's where we really work closely with them and kind of sharpen our pencils. So just because that number, it's the property taxes in Texas are the biggest line item for expenses. Anything else you want to add, Hayden?
No, I think that's pretty much it. It really comes down to the story of the specific property. And that's where digging into, like, for instance, on the Henry, we saw that the economic vacancy was 20%. That's a really easy indication for us that there's potential value to increase that income by putting in a good management team and really staying on top of the asset. And you can essentially burn off that loss to lease and those concessions, because none of the other comps in the market were running concessions too. It's all, part of that puzzle that you're trying to piece together to understand this whole story of these properties. And so for us, we saw, that's 10% to potentially boost income in a property that's taking in, $3.1 or $2 million. That's over $300,000 in additional income that we saw potentially add to the property relatively easily. So I wouldn't necessarily say that one is easier than the other to mitigate your risk. It just all comes down to understanding the story of the property. If you're a fully renovated property and you're leading the market, then yes, it's going to be very difficult, most likely, to push that income significantly. Then you'd probably want to focus on how can we trim expenses to, again, boost that bottom line. Because to your point, you can increase NOI through increasing income or decreasing expenses. Either of those will have the same effect on NOI, but every property is going to be different. Josh had a question. How do you guys determine your investors are legitimate? I can tell you from our raise for this property, you don't until you have a deal. So it's good to continuously expand your pool of investors, because if you're relying on a handful of people to contribute for your entire raise, people may say that they're going to commit, but until that deal is on the hook and it is time to wire the funds, you'll see who is legitimate and who is not. So it's good to pulse your investor database to have an idea of where you can be and don't stretch too far. So be offering on deals that you feel like you can take down, either with your investor base or with additional help that you feel like you can come together and make it happen. But yeah, you really don't know they're legit until it comes down to wiring those funds.
Yeah, and one question, I know Aaron Aaron addressed it, but regarding insurance. But yeah, we same thing. I mean, it's not the same line item. So I'm referring to insurance for property. It's not the same percentage as property taxes, but it can still swing things. And so yeah, we work, so Aaron's, great to work with. So we get quotes. We're not, it's a quick quote before we, and that's one of the things that we plug in when we're underwriting a deal. We just, we want to make sure that we're dialed in as much as possible. And then, once we get to that best and final stage is where, we really, dial everything in. I mean, there's a lot of the brokers kind of kid around with Hayden and I, because they'll call one of us and we're always on the phone with the other. So, and then our property management company kind of focused on this too. So, for that, but anyways, but we're constantly, kind of, it's a chat of back and forth of, we're trying to slice and dice the deal and trying to see all angles, and should we go after this? Should we just drop it? And we've done plenty of both. There's, the Arium deal is one of them. There's been quite a few other deals where for some reason or another, we just dropped it. There was another one we just weren't comfortable because it was they were big units and all that, but it was a B deal, and the price per door was really high, and we just weren't comfortable with that because we looked at what our exit was going to have to be, and we're like, my gosh, that's a lot per door, and it just didn't feel right. And so and I think I don't know. I think we ended up getting third or fourth place, and I think we still have room to run. We could have been competitive. We could have gotten first or second, I think, on that one. So, but we just backed off. It just didn't. We're, like I said, we're potentially in these deals for at least 3 to 5 years, could be up to 10. So we want to make sure we get a good one.
Absolutely. And yeah, whether you're looking, if you're looking to buy deals and do similar things to what we're doing, again, I just stress, this is a team sport. Having a great team that you can rely on is extremely valuable, not only in partners, but also, vendors that you work with for those items like general contractor, insurance, debt, taxes. Really build a team around you that you can trust. Because it takes an enormous amount of effort and a lot of back and forth. There's a lot of moving parts. When you're getting updated financials from the brokers, your debt's moving around on you a little bit, where your proceeds are going to be at, where your interest rate's going to be at. These are all things that you have to have a team that you can rely on and know that, when I call them to understand these changes, they're going to pick up that phone. They're going to be there for me. So, and just have a lot of patience, because there's some deals that, we've lost out on or spent hundreds of hours working on, and then you get second or you get third. And in this business, that means absolutely nothing. It's, if you're not first, you're last in this business. And it's tough because you spend an enormous amount of effort and it could ultimately lead to nothing. And that can be pretty frustrating at times. But again, if you have a good team that you can work with and you have a lot of patience and you're willing to put in the work, there's going to be a deal out there for you. Or if you're a passive investor, really look at who you're investing with, because, it's not easy to land deals. So you got to trust that you're investing with those that, aren't willing to stretch too far just to get that next opportunity. And there's a fine line there, and it's really easy to step over. So trusting who you're working with is extremely important with this business, whether you're looking to just invest passively or you're looking to do this actively. But yeah, I really appreciate everybody for joining. Brendan, shake and bake. That's right, first or last. But yeah, appreciate everybody joining. Dustin, if you have any final remarks for everybody.
Nope. No, I'm good. Yeah, appreciate everybody coming out. Look forward to seeing you guys October 11th. Gary will be speaking then, and really excited to see what he has to hear and go from there. So yeah, appreciate everybody coming out, and